Hello and welcome. My name is Mike Salco and I'm here on behalf of Bruin Asset Management. This video is part of a three-part series as a supplementary guide to Credit Suisse's second annual UCLA case competition. This video is part one of three, and we're going to be going over the UCLA case competition LBO template model that we've received from Julien Debinet over at Credit Suisse. As part one of this series, we'll be going over the cover, balance sheet, and income statement tabs of this workbook. I want to start off by saying that this is by no means a walkthrough or a guide on how you should build your model for whichever company you choose for this case competition. Instead, this is meant to be a more user-friendly version of the written directions that Julien's included on this model. So without further ado, let's get started. If you open up the workbook and you go to the first tab labeled Cover, you'll see that you have a space here to enter your name and the date created. These may seem trivial, but they will feed into later cells, so I do encourage you to do that. Go ahead and enter in your company name, project name, and ticker. And most importantly on this page, you do want to enter the pro forma date. What is a pro forma date? Well, Julien's left us a little clue here. It's your most recent 10K date. So if you go to the supplementary materials that he's provided, you'll find that each of you have 10Ks, the most recent 10Ks for the companies that you're doing. You're going to want to enter that date in here in the format displayed in the formula bar at the top here. This is very important as it's going to lead into future cells, and everything does build off previous inputs in this model, so you want to keep up. Moving on to the next tab, we have the balance sheet here. For those of you that have taken Accounting 1B, this will look very familiar. However, what you're going to do is you're going to input balance sheet items from the 10K in accordance to whichever year you have displayed at the top. These should update if you've done the right inputs on the cover sheet tab. So we've got cash, which is a line item on your balance sheet, pretty self-explanatory. Accounts receivable, for those of you who are not familiar with accounts receivable, these are the revenue that the company will receive for work done, but for which it has not yet received payment. Inventory, if your company has goods to sell, these are goods ready for sale, and other current assets. This is pretty much anything else that falls on your current assets on your company's balance sheet. There may be different line items depending on the different lines of business that your company is in, but you want to make sure that you keep everything inclusive there, and when you put in all the right numbers, they should input into the total current assets present on the 10K of the balance sheet of whichever company you're doing. Moving on to non-current assets, you have property, plant, and equipment. So if this were a manufacturing company, this would encompass all the machinery that makes whatever they make. Again, this can be found as a line item on the balance sheet of whichever company you're doing. Goodwill. This is more of a, I guess, a plug in investment banking that really just accounts for the non-tangible assets associated with the company. And then beneath that you have other assets. So this is, again, a more encompassing line item that is just meant to make sure that you're accounting for everything that may be on the balance sheet of the company that you are modeling for, but isn't mentioned specifically in this model. Again, at the end of total assets, you want to make sure that your totals are adding up to what the total assets is on the 10K of the company that you're modeling. Moving on to liabilities and shareholders' equity, we have accounts payable. So similar to accounts receivable, these are expenses that the company has incurred but has yet to pay, and salaries payable. So these would be salaries or wages that the company has yet to pay. And then again, an encompassing line item, other current liabilities. Depending on which company you're modeling, you may have other liabilities that you need to account for to make sure that this line, total current liabilities here, adds up to the same that it is on your 10K. Again, this is not a projection-based analysis that you're doing here. This is just accounting for everything that is on your company's balance sheet so that we have a base footing that we can work off of as we go forward. In terms of non-current liabilities, now we're getting into more of the balance sheet and less of the operating liabilities. So you're going to look at the long-term debt that your company has already issued. This is something that I highly recommend looking at when you're choosing your company. because a leveraged buyout is dependent a lot on how much debt you can load onto a company, you want to pay close attention to how much debt they already have on their balance sheet and how that relates to their EBITDA, but we'll get into that a little bit more later. Deferred income taxes is a line item you can find in the 10K, and other non-current liabilities. This is another one of those larger encompassing line items that you want to use somewhat as a plug to make sure that your total liabilities add up to what you have on your 10K. Then we get into common equity and retained earnings. These are pretty self-explanatory, just coming from your 10K. So your check down here should make sure that your assets equals liabilities and shareholders' equity. If you get anything other than 0 here, you've made a mistake, and you need to go back to look over stuff that you've inputted. So again, while filling out this tab, you should have the company that you're modeling's 10K open, maybe right next to it, and making sure that as you go down, these black numbers here are lining up with everything you're seeing on that 10K. Onto the income statement tab, we're now going to continue inputting historic results from our company's 10K. So at this point, we're not actually making any projections yet. We're just going to input the line items as we read them on our company's 10K. So we'll start at the top with total revenue. You're going to go back to 2010. Again, these numbers at the top should adjust depending on what you put in on the cover. But then it's easy as reading the corresponding years from the 10K and inputting the total revenue that you have here. If you read this little note that Julian left for us, it says consolidate items where necessary, and then feel free to create a new page aggregating different line items into one, but do not delete or add rows. So in order to keep this page functioning, we're going to keep it as it is. What he's referring to here is if your company has different lines of business or different revenue streams, I don't know, if let's say they sell cameras but they also sell digital media, then you're going to want to consolidate both those revenue streams into total revenue when you input them at the top here. So I don't know if I mentioned it earlier, but you're going to be only adjusting blue numbers. The black numbers indicate that they're formulas and they're going to be calculating themselves. Moving down to cost of sales, these are costs directly attributable to creating inventory or the services provided, and those are more typically your variable costs. But again, this is directly from the 10K, so don't get bogged down too much in the details at this point. We're just copying over numbers from the 10K. Moving down to operating expenses, these are more your fixed costs, your overhead, but they should be you should be able to find them easily in the 10K. Depreciation and amortization refers to the depreciation of the fixed assets of the business that you're modeling. This is a line item that can be found easily on the 10K. Now, while you're not going to be inputting numbers for EBITDA because they are going to be calculated automatically, I would say in order to perform well in this case competition, it is essential to understand what EBITDA is. So EBITDA is an acronym that stands for earnings before interest, taxes, depreciation, and amortization. And that is pretty much very similar to the cash flow that the business is going to generate before you start to account for its cap structure, the taxes it faces, or the large fixed assets that are necessary for it to do business. So EBITDA is a very helpful metric when comparing industries in different, comparing companies in different industries, and it's also going to be one of the main metrics that we look at when we start to calculate how much debt we can take on in order to buy out this company. So definitely keep track of EBITDA. Moving down to adjustments, you are going to want to look through the 10K to find adjustments to the EBITDA of a company. These are typically going to be irregular expenses or extraordinary expenses, things that are costing the company money on its income statement, but are not indicative of how they're doing business. So maybe bizarre lawsuits or I don't know, random acts of disaster like a hurricane or something. But anyway, moving into the next line item that we're looking at are capital expenditures. Capital expenditures are a company's investment into their own business. So if you were a manufacturing company, you would be thinking about the necessary equipment that you need to buy to continue manufacturing things, whether they're large machines or warehouses or stuff like that. But again, this is definitely a line item that you can find straight from the 10K. So the biggest thing here is to just, on this tab and the balance sheet tab, is to really try to the best of your ability to summarize what it says on the company's 10K. And at this point, we're just doing that for the past and then up through pro forma, so up through your most recently dated 10K. If we look over to the right here, we have compounded annual growth rate, CAGR, compounded annual growth rate for all of these line items. And you can see that the control panel for this is over here on the right. Julian's made it really easy for us here, so don't even worry about typing in numbers. Just select the first year you want to start with and then the year you want to end with, and it will calculate for you in these two columns here your compounded annual growth rate. So if you don't know what a CAGR is, I would absolutely recommend going and looking it up on the internet. But a quick and dirty definition would be the rate at which each of these inputs here needs to grow in order to get from the lowest value in year one to the highest value in the last year. And you can obviously play with your beginning and your end here, but that is the average rate at which it needs to grow with compounding to get to the end result. And this concludes part 1 of 3 of this video series. If you have any questions, my email is on the presentation that Julian supplied for you, but it's michael.salco@ucla.edu. Thank you very much, and tune in for the next video.